Are you new to investing? Do you often get overwhelmed not knowing what asset to focus on? Are you lost among the global economic shifts and geopolitical tensions arising all over the world? 2025 is the year in which a multitude of factors can affect where you put your money. Many things are unfolding in our ever-changing world, and putting your money into assets may make or break your path to prosperity. We all invest our hard-earned money in hopes of a return on investment. Knowing which assets are best to invest your money in 2025 is crucial more than ever before. There are many shifts and tensions occurring all over the world, and being well-informed about everything that is going on is important to stay ahead and form a long-term future-proof strategy that will build you long-term wealth. From U.S.-initiated trade wars on the world to ongoing tensions in the Middle East, the global narrative of investing into S&P 500 will provide long-term wealth is now declining as the U.S. declines. It is no longer safe to put your money into these ETFs that track the S&P 500. Many investors are now adapting and making changes to safeguard their capital into more reliable long-term investments. We will discuss which 5 assets will provide that security for you in the long term. U.S. companies have long benefited to the narrative that investing into American companies will provide you safe, long-term returns on investment. This may have been true before, but now in 2025 and beyond, due to rising powers such as China, this narrative is shifting away to favor other nations outside of America. U.S. companies have increasingly become overvalued and may crash any moment. People are losing belief and hope in companies in U.S. In my opinion, it is better to only hold a small percentage of your portfolio in U.S. shares. Diversify into other asset classes that are better for long-term growth. Before we get started, I will put in a quick disclaimer that I am not a financial advisor and the content within this video are for educational and entertainment purposes only. If you would like tailor-made financial advice, please talk to your licensed financial advisor. Always do your own research if the asset you are investing into is conducive to your investment goals and you understand it well and know the pros and cons. This video is designed to encourage critical thinking about global markets and long-term investing. Asset number 1 is inflation-resistant investments. These are assets outside of cash. Sure, keep cash as it is the most liquid form of asset you can hold, as you will need it for emergency purposes only. I usually advise 12 months' worth kept in the highest-yielding savings account. It shouldn't be any more than that. If you think about it, even though you are 1 to 2% ahead of inflation rate, you are still taxed on the amount of interest you earn per year. Overall, keeping too much cash is not ideal as its value is diminishing every day. Cash is not an inflation-resistant asset. Look into assets that can survive the test of time. Any economic downturns ensure you are well-equipped to weather that storm. Assets that are not dictated by interest rate rise or falls. You will need to grow and preserve your capital in the long term in order to have more buy-in opportunities. You should focus your resources on assets that are a hedge against inflation so that the value of your cash is preserved and grows. The goal for these assets is to ensure your money is not eroding and lose value. Asset number 2 is holding uncorrelated assets. These assets are well diversified and have a well-thought-out long-term strategy. Consider assets that do well in different seasons and times. There is not a single asset that exists that can provide year-round growth. All assets rise and fall. Build a portfolio that is well-balanced and are able to weather the storm. Uncertainty leads to fear, and fear leads to investors selling off their assets. By holding uncorrelated assets, you are ensuring you can strategically diversify your investments that will grow over long term. This provides a layer of protection that your asset value is maintained and will stand the test of time. It is important to note that past performance of assets is not an indication of future performance. What worked 10 years ago may not work now and in the coming 10 years. You must make changes and adjust to the current landscape. Following these principles will ensure you are well prepared for any economic crisis or global tensions. The sentiment of investing in your home country holds true among many investors all over the world. They know it best and believe in it. But consider emerging markets in other regions of the world that has potential power to scale. These are opportunities worth researching into, as the growth can create enormous wealth. This is the type of thinking you should adopt when diversifying your assets. If your entire asset portfolio is reliant on a single currency, there are currency fluctuation risks involved. If the fate of the currency declines, then your asset value will decline too. Currencies can be subject to manipulation, inflation, and devaluation. This is especially true if that country you are invested into is drowning in debt. Consider investing into assets that are in multiple currencies, as it provides another layer of protection to mitigate currency risks. The entire premise of asset number 2 is to be well prepared for anything that arises. Asset number 3 is investing into gold and strategic commodities. These commodities, especially gold, is a hedge against inflation and market volatility and is not just for capital preservation. Due to everything that has been going on in 2025 and in the coming years, the value of gold has been rising and is now providing a great return on investment. Gold is a tangible asset and one of those resources that are limited. It cannot be printed like money can. Gold is natural, and it retains its value. Gold has been around for thousands of years and has stood the test of time. If you look at the past events that have occurred, such as the global financial crisis and COVID pandemic, gold has always risen considerably. Gold cannot be diluted, defaulted, and is not subjected to geopolitics or government embargoes. It does not depend on anything or anyone. Central banks hold billions worth of gold as reserves. Many countries all over the world understand the power of holding gold, so they purchase billions to protect themselves on what is to come. Fiat currency or money is being devalued every time it gets printed. Rising inflation and interest rates make money more worthless. Gold, on the other hand, provides security, capital appreciation, and trust in a world of uncertainty. Other strategic commodities are oil, natural gas, rare earth minerals, lithium, and silver. Countries like China control the majority of these commodities and are well placed for growth. These sorts of commodities often outperform when paper assets underperform. Asset number 3 provide real natural resources that are tangible. When the financial system is in crisis, then holding these commodities is wise, as it can provide a good return on investment in these uncertain times. This should generally form a larger part of the portfolio with gold as the main focus. Asset number 4 is real estate and real estate investment trust funds, or REITs. Let's start with REITs. These are companies that own, operate, or finance income-generating property. They are funds that investors can access via ASX. REITs can be office, shopping centers, residential, and industrial properties. Consider a type of REIT that is well diversified, that is a hedge against inflation and economic uncertainties. Residential property is a great way to be exposed to real estate that is protected against inflation. Typically, property prices rise when inflation rate rises. People always require shelter in a form of a house to live in. It is a necessity in life. Therefore, people will be inclined to work in order to live and pay rent. This is why holding property as part of your portfolio is a great way to protect yourself. Rising interest rates does affect your cash flow, but if you buy properly, then your out-of-pocket expenses shouldn't exceed the yearly cash-on-cash return on your investment. The capital appreciation should outpace inflation and total property-related expenses. Rising interest rates may also work with you, as it may increase your yearly rental income due to rental demand. The great thing with property is that you can leverage the equity, and that is tax-free. When you leverage your properties, this can enable you to buy more property or other assets. If you want more passive property investing, then REITs are a great way to go, as you will benefit from ongoing income each year in a form of distributions and potential for capital appreciation too. REITs that invest into industries that are necessities, such as healthcare facilities and residential, can be a good long-term hold to build wealth. Therefore, it is wise to hold property within your portfolio. Property is a hard asset with an intrinsic value that, if bought well, it can appreciate immensely to create enormous wealth. Asset number 5 is emerging markets and power of technological innovation. With the rise of artificial intelligence, or AI, it will be wise to invest a smaller percentage of your portfolio to emerging markets. The key is to invest into emerging markets that have a focus on innovation. Improving something to be better and bring more value to people will create wealth. Emerging markets are economies that possess qualities or established markets and are transitioning from a low-income, underdeveloped nation to a higher-income and developed nation with a higher standard of living. The easiest, most accessible way to invest into emerging markets are via ETFs. There is increased EV production in China and regions of Southeast Asia and AI development in China. Asia is the future of technological advancements and innovation. They are already leading the way in most sectors of the economy. It will be wise to allocate capital to these markets. Investing into emerging markets is a hedge against stagnated established economies such as the U.S. market. When you zoom into factors that contribute to stagnation, you will realize aging population, diminished productivity, and debt to GDP ratios of the West is the reason. You simply cannot rely on historical figures as the future is changing and rewriting the entire narrative. Within the emerging market, the main focus is to look at scalability, solid macro policies, transparency, and durable competitive advantages. Do not follow others blindly and do not follow the hype. Mitigate your risk by strategic planning and researching the assets that work in your portfolio to fulfill your investing goals. Think long-term and implement a long-term plan. There may be market volatility in these markets as they are relatively new, but once they become established, then periods of growth should happen. Look for companies with strong fundamental growth. Emerging market companies trade off much lower valuations than Western companies. This is the reason they have very strong growth prospects. These 5 different assets that you should invest into in 2025 will provide security and protection against inflation, economic uncertainty, and market downturns. Hard assets that are limited in resource, such as gold and other commodities, provide great capital appreciation in these uncertain times. Real estate retain intrinsic value, provides passive income in the form of rental income and capital appreciation. Property usually outpaces the rate of inflation. Emerging markets are key to strong fundamental growth prospects. As these markets are growing, so too will your capital invested into them. Limit your exposure to Western companies such as S&P 500, as they are now an overvalued, diminished true value and is on a decline. Protect yourself by strategic diversification, by holding uncorrelated assets and focusing on inflation-resistant investments. So, what's your next step? Let me know in the comments. Don't forget to like this video, subscribe for more content like this, and share it with someone who's ready to level up their financial game.